Welcome to Subramani. One question which people keep asking is where should we invest? Of course, where you should invest depends on what your financial planner is telling you, and depending on your risk profile, etc., etc. So it's fairly obvious that you should go through a financial planner, or you should know how to do it yourself. Assuming other conditions remaining same, constant, and you have a choice of whether to invest in mutual funds or whether to invest in equities, whether to invest in private equity, whether to invest in listed equity, whether to invest in real estate, in farmland, etc., PMS, right, all those things, AIF. My choice would definitely be listed mutual funds, and maybe if you don't want to take the trouble of changing fund A to fund B, etc., and nobody is willing to, and you're not willing to put in time and effort to learn that, maybe just index funds. Why index funds? Because my answer for why equity earlier used to be very complicated, saying it is the best asset class, it captures the best of what is happening in the economy, the best shares will do well, so if you buy the index you will earn well. That is of course true, but over and above that, there was one man called Jack Bogle of Vanguard Mutual Fund, late John Bogle. We lost him some time back. One thing which he did was he dramatically reduced the costs in mutual funds, so much so that Indian regulator copied from the US, and even with much smaller volumes, the costs of buying index funds in India, or maybe even ETF, is dramatically less than what you would pay in for other asset classes. So let us just understand, if it is private equity, I will first talk only about costs, and then there are other advantages. So when you talk about private equity, you do not know whether the fund manager who is managing your money has got a private deal from the other entrepreneur, right? So your money is invested. So your private equity manager goes and talks to some other person and says, oh sir, this share is available at 125 or 150, and I think if it's worth buying it for 7 years, here is the valuation report, blah 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 blah, and he just goes and makes an investment. You have given him money, and after that he does not come back to you for every transaction. So you have just, and what is the fees that you're paying? Well, you're paying say 2 and 20, which means you're paying 2% fees, plus you're paying 20% of the profits above a hurdle rate, or 1 in 30, or all those kind of formulae are there. There's no one flat formula. There's nobody saying, okay, it is 1% fees or it is 2% fees. So you don't have that available. So private equity costs are high. Similarly, in some PMSs, the costs are high. You have to find out. PMS is also still regulated by SEBI, but private equity is even less regulated by SEBI. And you don't know how much you trust your managers, and you do not know how much you trust the entrepreneur on the other side, because we've seen all kinds of mistakes, frauds, etc. happen. So unless you trust the manager completely and totally, and you know him for a very long time, and you're sure that he is not doing any private deals, it's very difficult to trust the private equity manager. That brings us to the next one, the AIF. Again, AIF is on a higher cost. And in case of an AIF, you don't even have somebody else also monitoring that. Same thing for private equity and same thing for PMS. When you invest in a PMS, let's say there are 500 others who have invested in that PMS or AIF or private equity, you barely know them. So they also don't have enough information, or they also have the same information which you have. So, and then it is up to your ability to understand what is happening in the business. That's not easy. Secondly, there could be a lot of fluctuation. 3 years later, you could be frustrated saying nothing is happening in this business, should I get out? And 4 years later, you could be actually saying, wow, this is fantastic, can I get more such deals? But the reality is known only when your private equity fund manager exits that business after 7, 8 years, 10 years at a good profit. Then you know it was a good deal. Till then, you are just guessing. There is no day-to-day quotation available on how that business is doing, which is good enough so that there is no great pressure by that entrepreneur to produce something quarter on quarter, but somebody has to be monitoring all that. It is assumed that your private equity fund manager is doing all that and he has the capability to do it. So we are not even getting into competence. I am only talking about fees. Same thing holds true for PMS or your private equity. Whenever during the period when you are holding, there are not too many people doing an evaluation. Now if you take a mutual fund, if it's an index fund, there is not really much to monitor. You are just seeing whether the tracking error is more or less, or is it too high. Other than that, there is not really much to monitor. If the economy itself does badly, if the market does badly, your index fund will do badly. If it does well, you will do well. That's all. It's as simple as that. In a PMS or private equity or AIF, there is nobody else monitoring. So there will be no headline in the newspaper saying this fund is not managed well. There is front running. Nobody knows whether there is front running in the private equity, in PMS, in AIF, right? You don't know. In any of those cases, you just are hoping that the fund manager has a good team which is not doing any of these hanky-panky things. So second one is on the compliance thing. First is on cost, second is on compliance and visibility available to you, and also exit available to you. In a private equity, or you could have a 7-8 year kind of lock-in, and let us assume things don't work out or the market is not in great condition, so it could be 10 years. Before the 10th year, you may not get exit at a decent price, and so it's a 10-year lock-in. So is it worthwhile? That's a question you have to ask yourself. What about real estate? Well, real estate had no jack boggle, so nobody is there to reduce the complexities of doing a real estate deal. So you do a real estate deal, and I think the friction cost is 10%, which means you buy on a Monday morning and you want to sell on the Monday evening, or say maybe a Friday evening. The gap between buying and selling will be at least 7-8% because of brokerage, etc. And if you've got it already transferred in your name, then you paid stamp duty, GST, etc., then you're in much bigger trouble. So the cost of getting in and getting out for something like real estate is too high. So it has to be a usage asset. Similarly for gold, jewelry, if you're going to buy and sell jewelry, then it is not worth it because of the making charges, right? So again, the impact cost in real estate, impact cost in gold, jewelry is very high. Gold, if you want to buy, you're buying ETF, it's very different. If you're buying jewelry, it's very different. Even buying coins and biscuits and chain with very minimum of working charges or making charges, then it's fine, but otherwise it's very expensive. So real estate is difficult to get in and out. PMS and AIF, there is nobody monitoring it. The biggest advantage in mutual funds, even assuming you're not in an index fund, for the fund trustees, etc., who are monitoring it, it is possible to go and check the transaction at what price it got done on the stock exchange. Let us assume he bought it on the National Stock Exchange at 12/13/05. You know, at 12/13/05 a contract is executed, the contract is fair, the broker has given it to you, and the backing of that contract is on the NSE site. You can go and have a look at what was the price of that particular share at that particular time. So this kind of back-end feedback is not available on real estate. Yes, in PMS and in private equity, in PMS and AIF, this is available. Of course, private equity deals are subject to the transaction between your manager and the promoter. You don't know the real story. If there is a hidden story, you don't know any of those things. So if you are a common man and you're feeling that, oh, I'm missing out on all the private equity deals and AIF, really PMS, you're not really missing much. It doesn't really matter, because private equity deals, I met in a venture capitalist, and I know one private equity person was saying that apart from one or two of his investments, he has about 12 or 13, apart from one or two of his investments, all the others have underperformed the Sensex, right? I mean, he was talking about the dollar index, because he was investing the dollars into this. So he was actually not performing too well, but luckily for him, all his deals were closed except one which was to be closed, and he was closer to retirement. So he says none of them performed so well, most of them underperformed the index. So if this kind of data is available, so if you're getting good transparency, low cost, and a good range of assets. You could buy not only, I mean, I am not a big fan of index funds simply because of the taxation structure. I prefer hybrid funds, right? So that's a good option which is available. So look at all those options, look at cost, look at transparency, look at how involved you want to be in, right? Once you look at all that, for most people the answer is equity, and the answer is maybe index funds if you don't want to take even that much of understanding and do it, or equity funds. The problem is, we have all seen that regularly the market falls and goes up by 10%. That is regular. Every year you will see at least 10% up and down. Every few years, 3-4 years, maybe 5 years, you will see a 20 to 30% fall and 20 to 30% gain. So that also happens. And once in your lifetime or twice in your lifetime, largely maybe just once in your lifetime, you will also see a 50% fall. You have to be ready for all that in equity. Of course, the same is true in whether it is private equity or PMS or AIF, but I am saying you have to be willing to look at that. That is the only problem, that you have to have the ability to sit tight during bad times. But that is true for real estate also. But what happens is, real estate price is not thrown at you every day, right? So let's say you bought a house for 2 crores, and then you keep telling your wife that it is worth 2 crores. Even if the neighbor sells it for 1 crore 80 or 1 crore 70, you say no, our windows are painted orange, so his windows were painted green, so he had to sell at a bad price, or some nonsense like that, right? But because the price is not thrown out at you. Now if you have invested in, say, a particular equity share, and that it goes up or goes down, every day it is being tweeted out to you, right? It is running on a ticker. Your wife comes along and says, you bought the share for 100 rupees. No, see, it is now 930. See, you have lost money, right? You don't have to hear all that with others, because they don't give you the price on a day-to-day basis. So yes, I think if you have the discipline to sit through long cycles, which you need for all asset classes, you're better off with a mutual fund. And if you don't want to put in the effort, index funds. Thank you.